So we will start with the panel itself, and then I will start not to talk anymore. And the first element that we wanted to discuss about, it was we have three main elements to discuss. One is politics, one is economics, and one is market. We're gonna start with the politics, and of course, let's begin with the dominant political event of 2024, which has been the US presidential election and the global impact that he had. I will start, if you agree, with Madison, if you can give to us a little bit of insight on that. Thank you.
Of course. Hello, everyone. I'm honored to kind of kick off our panel today. Thank you, Serge, for the warm intro, and thank you for inviting Vanguard to participate in such a great event. We could likely take the whole panel, I think, talking on this one topic alone. So I'll try to keep it brief, but thinking back in 2024, the US presidential election, I would define this by saying it wasn't just an American moment, it was really a global headline. On one side, you had Kamala Harris seeking a full term. On the other hand, you had President Donald Trump aiming for a return to office, and the world was watching with a mix of curiosity, concern, anticipation. Taking a look at that race, it offered two very different visions for the next 4 years of American policy. And taking a look, just zooming out a little, why did the world maybe care about this election? This election was really coming at a time when the world was juggling multiple crises. There was wars in Europe, wars in the Middle East. We saw rising tensions with China, a growing pressure on democratic norms, and the next US president could help to shape how the world responded to some of those challenges. In other news, other things happening to set the scene, global markets were bracing for potential trade policy changes. You had climate advocates watching for either signs of US leadership or, on the other hand, retreat. And also tech leaders, they were eyeing different potential shifts in regulation, even innovation strategy. So, just setting the scene a little bit with that, against that broader backdrop, I want to tie this back to investment decisions and kind of the client portfolio as well. As the presidential election approached, Vanguard reminded our investors of a very powerful truth, and that is, elections may shape policy, but they don't actually dictate portfolio performance. We did research on this topic, and our research looked at data going all the way back to the 1860s. And what we found in doing that was there was no consistent relationship between presidential election outcomes and the returns of your balanced 60-40 portfolio over the long term. So in other words, there's a lot of noise, a lot of news and headlines out there on this topic. Markets are definitely driven by a complex mix of factors, but trying to time, politics is really, in summary, a losing game. And while presidential elections absolutely can be hugely consequential in terms of the direction of public policy, they should not dictate investment decisions. And that's why we really encourage clients to stay focused on what truly, drives and defines long-term success. And that's things like diversification, your discipline, and really just a plan built to weather all seasons, including your election years.
Thank you, Madison. Esteban, as a global investment strategist, what has been your impact of view on this political event end of last year?
Of course, and thanks again for the question, Serge. I would start by saying that this event and the series of events that have unfolded around it have allowed us to, strengthen and reinforce what we have been saying for many years, probably even decades, which is this relevance of diversifying a portfolio and not only focusing on a country, region, sector, company, set of companies that have been performing well. And again, it's not only the elections, but the first few months that have strengthened this call to diversify, not only in terms of regions, but also in terms of asset classes and within asset classes. And that alone has brought, I would say, a lot of value for investors, because we were used for many years to a super robust and strong story in the US. We spoke many times, even at the beginning of this year, still of US exceptionalism and how different the US was compared to other countries. And clearly, these few months of 2025 have allowed us to show that, yes, there is an exceptionalism story out there. However, it seems to be a dual type of story. Top down, meaning on the economic and political front, that exceptionalism seems to be weaker than before. Some say it has been lost. We don't believe so, but clearly it has deteriorated. However, there is still an exceptionalism side of this story, which is bottoms up. In other words, on the industry and company basis, and especially on IT. Still, the Magnificent Seven and US IT probably are the key sector to be in when we think of the US. So in a nutshell, although the political environment has brought along volatility, for many months it brought along negative views of what not only the US but the global economy and markets in general might show during this year. Clearly, what we have seen is that we cannot rate everything with the same measure and think of everything in the same way. We need to be selective, and we need to realize that even within chaos, there are positive news and positive stories out there that need to be part of investors' portfolio. So within that diversification call, the US still has a place. Nevertheless, right now it has to be, again, as I said, a selective type of approach, and IT, where we see this exceptionalism story still unfolding, is one of those stories to have, Serge.
Okay, thank you, Esteban. Reto, same question, same topics. What is your comment and view?
So first of all, good morning, everybody. So thank you for the invitation. And of course, it was a very, it was the topic of last year, and it is also consequences for this year. But just going back to 2024 and looking through all these election campaigns, right? I think it was a bit of a drama that you saw. And at the very end, we had President Trump winning. And I just remember all this animal spirit coming back, this very positive outlook for the US market. He was seen as very market-friendly president. There was all this excitement about deregulation, about M&A activity coming back, about lower taxes. And there was a lot of excitement. And interestingly, what we saw was, so this relative performance that peaked, or the relative outperformance of the US market that peaked end of the year, right? And then we had all the other stories, and Liberation Day as the big surprise to the market, right? Because sentiment between October, November last year, and then in April this year is very, very different. So not so market friendly as most of us have expected at the very end. And here I would really agree with what we have said before. Diversification helps here, right? We had a lot of exposure to the US market, and we have seen this foreign holding of US assets that have increased a lot, right? And now all the discussion about exception limit, what will the US market do? So I really believe it's diversification. I guess we discuss AI and innovation later. I don't think that disappear from one day to the next, but I guess now much more serious question about the position and strengths of the US in the global market.
Thank you, Reto. Michael?
Yeah, it's always easy to come at the end of, of such a
Don't be
conversation.
afraid, you will not be
Yeah.
always the last one.
Okay, good. Thank you for that, Serge. Well, look, I mean, this so first of all, thanks for having us, thanks for having me, and also to my colleagues here. Great answers, very insightful. I do think you know, I do a lot of EM work, emerging markets, and you know, to the extent that Madison explained, it is true that going back to sort of late in the 60s or even before, we don't see a consistent pattern, whether it was a Republican or a Democrat winning ultimately, you know, based on the strength of the US economy, based on the strength of US companies. You know, the rule of law, this pool of innovation, the bottom-up story that I think Esteban and also Reto were referring to, that's been pushing US stocks, the US market higher, and that has helped people, you know, to seek exposure to the US economy. At the same time, I do think it's worth remembering that, you know, and again, here is my EM experience that I do believe is relevant. It is worth spending time, you know, looking at these leaders, in this case, President Trump, and trying to understand what is really relevant to him. And the best way, in my view, to do this is to just go back to his campaign and just pick the sort of 4 or 5 topics that he spent most time talking about, the ones that really is close to his heart. And that includes, you know, lower energy prices. And we can conclude he achieved that. Yeah, there's a bit of turbulence right now, you know, between Israel and Iran, but overall energy prices are considerably lower. He talked a lot about immigration and, you know, drug trafficking, etc. You know, I think Esteban would be great to also opine on that, given his cultural background. But also, by and large, he achieved that. And we need to be on a forward-looking basis to spend time thinking about what all that means for US labor market dynamics, for US labor market tensions, and potentially a bit of a structural, you know, tailwind to, you know, higher inflation. You know, Reto mentioned the tariffs and how that was a shocker on 2nd of April, but also, importantly, Trump realizing he has a great ability, in my view, to read the room, realizing that this is now different from 2018 when the Chinese just nodded. At this time, people retaliated. You know, 9th of July is going to be a very important date in that regard. But I do think the tariff policy will ultimately end, you know, in much lower universal tariffs and perhaps select tariff on select industry than what was initially announced on 2nd of April. There's a great deal about reindustrialization, and we'll see more of that as companies try to build exposure to the US. It's a very important one to monitor. And by the way, you know, it's not only bad, right? If you think about the company like TSMC, them being present in the US market domestically might ultimately be a great thing for TSMC shareholders, right? So the jury on that one is still out. The elephant in the room is them addressing this huge pile of debt. And you know, and that's really, I think, what we're going to be busy with this year and perhaps next on the administration, trying to find a way to somehow reduce this 37 trillion debt pile without destroying the economy, without, you know, putting taxes on domestic companies and consumers, finding a way to, you know, put that on perhaps foreigners as well, as we see now with this new tax bill. I think that's going to be a clear challenge. And so I would really second what Esteban said about, you know, US exceptionalism is still there. You know, we're still finding some of the most exciting companies in the United States, equities. I also would say, you know, the liquidity and the depth of the US Treasury market right now, it's not very popular, but, you know, comes push to shove and we go into a crisis. I'm pretty convinced people will fly to, you know, US Treasury market because Powell very likely could slash policy rates by 200, 300 basis points in such a scenario. The weak link in this equation is the United States dollar, which looks still expensive, not against the Swissy, but against many, many other currencies, including euro and currencies in Asia. And that, in my view, is one of the most likely channels that the Trump administration can use to at least partly address the elephant in the room, which is the debt stock. Back to you, Serge.
Thank you, Michael. So thanks to all of you. So if I can just sum it up, this small part about the politics. So you have been stressing the drama element at first when the event occur, and then what really does make and does matter, and the kind of implication. So in the fact that the market, depending on which president is elected, which party in the end, is not maybe the most important element. You stress the element of diversification in the investment strategy, which is something that still there, and this is still a very good element. You also mentioned the fact, the selectiveness, the IT component, and the US exception on the market, that to you there is a high potential that these kind of things will not change in the future. Then the hopes on the kind of deregulation that occur or do not occur, the problems of the tariff policy, and then all the element and what you said, Michael, what is relevant to the president and the kind of things that he will continue to act, and then we have to monitor that in a close way to position ourselves positively. When we come to the economics, there is three elements that we wanted to touch with you today. That is the discussion we had together. I just mentioned the three elements, and then you're gonna address them as we did just now, one by one. The first element was the US economic exceptionalism and global growth dynamic. You touched it a little bit, just to take into consideration the fact that last year the Standard & Poor returned 25%, which was a huge result. We wanted to talk a little bit about also the global monetary policy and interest rate, and the last subject that we wanted to touch is China and emerging markets. Can we maybe, I don't know the way you want to do it, you can intervene as much as you want, but can we start maybe with US economic exceptionalism and the global growth dynamics? And then, Michael, you continue, you will start first this time.
Awesome. Thank you so much for that, Serge. Well, okay, on the US, I touched on some of these things already, and
yeah.
So let's be clear, right? This is not a new story around these sort of vulnerabilities. You need to go back to the 70s. So that's 40 years, right? 40, 50 years to find the last time the US had sort of consistent surpluses on the current account side. And you need to go back to the 60s to find the last period when they had, sort of a balanced fiscal account. And, many people on this call will remember there's been periods when people questioned the future of the dollar. Even in my career, which is not 50 years, it's not 60 years, this has been a reoccurring topic that we discussed many times. But I do think we don't need to run to conclusion now, because President Trump arguably is a bit different from some of his, other presidents, that we quickly write off the US. Reto made the point, Esteban as well. I do think Madison as well. There's some really great things happening in the US economy. First of all, it is a huge domestic market. It's the biggest on the planet. So companies having access to that market, and perhaps again, even companies that are quote unquote forced to help on the reindustrialization mission, might find that very, very beneficial. This is a market that we know, because of its ability to provide protection of shareholder value, to provide rule of law, to have large liquid capital markets. These are all attributes that are very, very hard to find elsewhere. China is a huge economy, but China by and large follows the 5-year plan of the Communist Party, which doesn't have shareholder value as one of its top priorities. That's just a fact, right? This common prosperity and make China independent from US tech, etc. These are some of their priorities. And so when it comes to investments, we do believe as an institution, the US is still a great place to be. The issue, as I said, is around dollar weakness, and our small institution, the clients we deal with, we have a lot of them, almost most or all, that currently look into ways to hedge dollar risk, because we do sit on a lot of US assets, which again we probably still like, the average client at UBS, but they're increasingly uncomfortable with the dollar exposure. And so that's a topic that I do believe is very, very critical for 2025 and beyond.
Reto, if you can express yourself also on that point, and maybe to start to touch a little bit also global monetary policy and interest rates.
Sure. So first, I would agree with Michael. On the one hand, long term, the US is still a good market, especially with regard to innovation. I think it's more about governance in the US where people are looking at. But I mean, with regard to size, it's quite difficult to invest. I mean, the amount we talk about now, so it's 80 billion or whatever foreign holding of foreign investors on US financial asset. But what I think is more on short term, I mean, there is a lot of uncertainty from all the tariffs, right? I think it's super difficult for companies to make investment decisions, for example. So we are a bit more cautious in the short term to see what the US GDP growth will look like, right? So that comes down. We have 1.2% growth this year, about half of what we think is potential growth. So here we are a bit cautious, but longer term, I guess, yes. I mean, we still have this innovation engine. We will discuss AI, what is about productivity, for example. I mean, there are still a lot of positive factors. With regards to the monetary policy, we have two cuts. I think that's the consensus right now. So I think the Fed will wait. And then in the second half, when we have a bit more stability around what this taxes, where it is, and what are the consequences of it, then if they have a bit more certainty that the Fed can lower the rates, and then next year we have another 3. So that's our forecast. And for others like the ECB, we expect a third cut. We also have 3. That's 1%. Inflation it's coming down, like could be a problem. It's a bit on the monetary policy side. The view we have there.
Okay, thank you. Esteban?
Definitely. Thank you very much, Serge. I think, when I was listening to Michael, to Reto, I was remembering how the media often speaks about Trump being erratic, no? And I always smile when I see that word, because some of the media try to give the impression that Trump's head is all over the place. He has no strategy, no idea of what he's doing. We believe he definitely knows what he's doing, and Michael mentioned it a little bit with, by referring to things that are close to his heart. And let's remember what the root of the MAGA movement is, no? Which is basically to make the US competitive on the global scale. And how can you do that? Well, by having a much weaker US dollar. And whether we see it or not, he has been pursuing several paths and avenues to achieve this. One of them, clearly, with the extremely high tariffs, which, of course, in the end, might make it less attractive to be a partner with the US, and that alone lowers the volume of dollars, lowers the demand of dollars to do business. But then, simply by sending mixed messages, simply by making the growth outlook a little bit bleaker, that also weakens the US dollar. By allowing the speculation grow about suppliers transferring tariffs to the end consumer, to the US consumer, which accounts for 70% of GDP, that also weakens the US dollar because it implies higher inflation. And indirectly, going to your question, Serge, indirectly, he puts pressure on the Fed to lower rates. No, of course, because the Fed needs to keep growth, needs to keep inflation from going too high. So there is this indirect pressure for the Fed to lower rates. And again, when you see everything as a package, you clearly see a strategy to weaken the US dollar. Now, the two questions are, first, can he take this too far? And the only thing that I can say here, Serge, and I'm sure my colleagues, Michael and Reto and Madison have read this white paper published by one of his senior advisors, Stephen Miran. The risk here is that there are a few other avenues that he hasn't tested yet, which could weaken the US dollar even further. And just one example, forcing the conversion of treasury bonds to 100-year bonds. Will he do that? Who knows? The only thing that I would say is that remember, time might be in the best interest of the markets because the US has midterm elections in November of 2026. So if he and Republicans want to reach that point with a growing economy, with booming equity markets, and with a completely different stance, not only from investors, but from consumers, then probably this chaotic environment we are living in should not last too long. That's a little bit of what I wanted to share, Serge.
Thank you. Madison?
Yes, of course. I think the other panelists have done a fantastic job talking about US exceptionalism. Maybe a little bit to add from me on that front. I think if you put the year-to-date period aside, US stocks have been on a winning streak in recent years, and 2024 was no exception to that. Think back to the earnings growth beats that we saw, the valuations climbing, overall investor optimism staying quite high. But I would put a forward-looking lens to that and say, what comes next? That's the real question. And I would define it as, and I'm hearing this in the other panelists' answers, we're at a crossroads. And, the way maybe I would kind of paint that picture is, are we in the early stages of a productivity boom like we were in the mid-1990s? Reto, you mentioned, AI. Can that drive some productivity? Or on the other hand, are we closer to 1999, where you saw lofty valuations, exposing, sudden economic shock and the stock market was left more exposed? I think the answer to that question will shape what comes next for markets in terms of this topic. Serge, you also asked about global monetary policy, maybe just my 2 cents on that topic. Starting with the Fed, there's been a lot of movement over the course of 2024. We saw, even prior to that, a long stretch of aggressive rate hikes in 2022, 2023, and then 2024, you see that flip. The Fed cut rates 3 times over the course of 2024. A whole percentage point was dropped, lowered the federal funds rate. Inflation was cooling. The economy showed signs of softening. The Fed's message through all of this is we're easing, but carefully. Over in Europe, ECB, they began a rate cutting cycle midway through 2024. They paused it, in July, but then picked it right back up again, back-to-back cuts of 25 bips, really at every monetary policy meeting since then. Same thing, inflation falling in the region, growth stagnating, and you see them acting decisively to support the economy with that backdrop. The question I think that investors should be asking themselves is, what does all of this mean then for terminal interest rates as we move into, the latter half of 2025? And I think the short answer is, even despite the cutting cycle that we've seen in the US and Europe, is, our projections are that terminal interest rates should be higher than what we've seen during the post-GFC period. Plus, another positive, we are now in this era of sound money, meaning positive real interest rates. And we see that continuing into the future as well. So going forward, kind of the so what I would say for investors is this means bonds are primed to be a very important driver of total returns in a portfolio over the next decade. So, bond investors, multi-asset investors, they're really poised to benefit from some of these dynamics.
Okay, thanks a lot. So maybe 1 or 2 remarks on my side. You mentioned the historical element of this situation back to the 60s and the 70s. I mean, I'm a great lover of history, so that rings a lot of bells to me. It's very interesting. Your currency, but our currency, but your problem. Mentioned the U.S. Competitiveness that could be helped also by a lower U.S. dollar. The size of China, but always the biggest market, innovation development in the U.S. And you mentioned, I mean, a lot of it was linked to the U.S. dollar, and maybe a small joke that we could change the MAGA into the make US dollar going lower again. And so that's one of the elements that it's for all of us a huge question mark, because as you mentioned, we have a significant amount of all the investment done in the portfolio, which is linked to US assets. And that kind of impact could be very devastating. And turn the treasury in 100-year bonds. I mean, this is the kind of thing that frightened everybody. Maybe one element that I would like, I don't know which one of you, I'll leave it open to you. Can we maybe just talk a little bit about China and emerging markets?
Serge, maybe before you go to China, we have a question from one of our participants regarding the low dollar, or what's happening with the dollar. This person speaks about the U.S. Senate with the stable coin legislation that passed this week, and with this idea to hold dollar for dollar reserve in short-term government debt. And the question is, should this support the U.S. dollar?
Okay. Who wants to take the question?
I mean, I can start if I may. So short answer is no. The idea is that, you know, people say, well, if you have stable coins, you know, you give your money to this institution, whoever manages the stable coin, and they will invest it on your behalf in T-bills and other short duration instruments. They by the way keep the interest rate for themselves, but you get a cheaper payment token or coin. Now, whether you do that, you know, through a stablecoin entity, or you do that with your conventional bank, ultimately makes no difference in the demand for T-bills and short-dated bonds, because, you know, we, UBS, Julius, Baer, LGT, everybody else, you know, we do the same with the money that you have on our cash accounts. It's not that we, you know, it's there, it flows back into the monetary system. So I think the marginal sort of this view that this marginally is going to increase the demand for short-dated paper is I think economically simply wrong.
Somebody else want to comment on the question? Okay, if it's not the case, thank you, Michael. So China, emerging market, some comments? Esteban, maybe, yeah?
Well, of course, this question is for Michael, but he just spoke, and then I'm going to add a little bit from my side. Yes, because he has been following this region for many years, always super successful. So in this sense, just would say a couple of things about China, and then one more thing about China. I think many are confused about how strong the economy is really unfolding, and how, let's say, solid the investment case in China is. What I would just say in that sense is that keep in mind that China has been consistently announcing support measures throughout the last 6 months at least. If it's not a subsidy, it's lower rates. If it's not lower rates, it's a special package for a certain sector. But it has been consistent. And of course, because it has been consistent and not everything in one single moment in time, yeah, people tend to think these are not meaningful. On the contrary, I believe that during the second half of the year, we will see the bulk of these measures starting to, to have a positive effect on the economy. And to those that believe China is set to grow at low rates, probably rates going back closer to the 5% might surprise them. So don't understate the kind of support measures that have been taking place there. And the other story that I want to highlight is the case of India, because we rarely speak about India, as India is growing not only now, but definitely the next couple of years, probably at 2 times the speed of the average growth in the world, so 6 to 7%. It is also a story where the government has been pushing different measures to foster growth, very recently lowering rates 2 times more than what the market was expecting, reducing bank reserves ratios to foster liquidity. Of course, we can add to this the demographic bonus, the amount of people that will become, economically relevant in the next decades. So we have 2 stories in Asia, China and India, that probably need to be part of an investor's portfolio.
Okay. Interesting.
Just before handing
Yes.
over to Michael, on India as well, I mean, there is all the discussion about the tariff and the uncertainty, but India is also a market which is more domestically driven, a lot of infrastructure investment, right, that should help. And of course, the tariff we will hear about, but it's not so much dependent on export. It's really this internal domestic growth from the investments in domestic infrastructure.
Madison, do you want to?
Sure,
Yeah.
I'll jump in before we give it to you, Michael, as you are really the EM experts. But maybe just a couple thoughts from me. By some measures, take a look at China, and you could see that it crossed the finish line in 2024, perhaps with a win. The GDP kind of growth hit the 5% target kind of set forth by the government, thanks to kind of a strong year-end push. Really, the engine behind that was robust industrial production, resilient global demand, front-loading a bit of export orders, but kind of look beneath that headline, and the story is a little bit more complicated, kind of as it always is. And while momentum may carry us into 2025, there may be some cracks forming. So take a look at excess capacity or weak domestic demand, sluggish housing market. These things start to raise, red flags, and there's growing concern that China could slip into, perhaps a deflationary cycle. And some of the data has backed up, some of those points. So take a look at consumer prices. They were flat back in December. Annual inflation slowed to very low levels, just above kind of flat. It's been declining for months. Producer prices dropped year over year. They've been down for, over 2 years, kind of monthly declines. You have lukewarm private investments, muted credit demand. All of this is just a reminder that headline growth doesn't always tell the full story. China's economy is absolutely evolving, but so are the risks behind it too. But Michael, would love to hear your thoughts.
Thank you. Well, thanks. So, look, just maybe a few things that first of all, I wanted to mention that when we talked about monetary policy, because it wasn't covered. I mean, sort of more or less subscribe to what others said about the G10. Big divergence there, right? Just the S&P, is sort of on the path potentially toward negative rates. Others like ECB more hesitant, focused a bit more on inflationary risk. But this backdrop that we sort of portrayed around the US dollar weakness provides a great tactical opportunity for central banks in emerging markets to ease policy condition. We have this environment, yes, slowing growth in the US and elsewhere, and high rates, sort of relatively well-behaved inflation, a desire from this US administration to have a weaker currency. This sets the perfect breeding ground to perhaps, for countries in Central and Eastern Asia, have a bit of currency strength, but then sort of compensate that with more policy easing. Madison said it. It's like this is an environment of good money, in the sense that real interest rates are in positive territory. So we've been selectively adding duration exposure in emerging markets, FX exposure as well, including Latin America, which we do think looks quite interesting. Brazil. Now on the sort of China and India, I think lots has been said. The way I think about this is, I think, very much in line with what Madison said. We did some very interesting research and just looking at GDP growth and how we can project that multi-years ahead, that's sort of actually quite, doable. Where it gets really interesting is when you start as a next step to look at the link between GDP growth and, say, EPS growth and equity market performance. And there, I can just second what Esteban said about the attractiveness of India. There's other smaller markets in Southeast Asia, for example, the Philippines, that really stand out as potentially having, great years ahead. UAE, for example, in the Middle East is an interesting market in that regard, versus, China is somewhere in the middle. Yeah, growth is still sort of solid, and the quality of the growth, I would argue, has increased a lot, and they've proactively dealt with the housing issue. That's still a bit of a headwind, but it's petering out. They're focusing on reforms, they're focusing on stimulus. China, in my view, will emerge as a winner from the current confidence crisis, I would call it, in the United States, because they're doing a lot of things really, really well. But again, the flip side is that economic growth doesn't necessarily mean EPS growth, and hence we do need to look at this very, very carefully, as per Madison's comments.
Thank you. Very interesting. I mean, emerging market in terms of results, globally speaking, on market evolution has been maybe 10 or more than 10 years of a desert traversée. So maybe that's gonna change. I mean, you mentioned India, China, UAE. So that's very, interesting elements that can bring also positive development in the diversification itself. For the sake of time, I will just ask Patrick if there is a question from the audience. Patrick?
Yeah, sorry, I had
Yes, it must be.
microphone problem. Yeah, no questions. No.
Okay. So just very briefly, as into bracket, it could be considered as a joke or not, but we wanted to talk about some small elements. So there is two, bright. Everybody talks about it. Everybody is looking for it. Everybody is enthusiastic or skeptical. Just very briefly to conclude this discussion, what are your view about gold as it at the peak of everything, and of course the counter element, which is crypto? So who want to take it, very briefly? We have 2 minutes.
If I may, very quickly. So as far as gold goes, we have a positive view in the sense that the engine behind the prices going up is really central banks. And why central banks? Because for a long time now, they have been replacing within their reserves mostly US Treasury bonds for gold. That is probably it will continue to be the case, especially with China. And again, it is important for us to remember a little bit about the sizes of these markets. Being very simplistic, the US Treasury market is almost 3 times as big as the gold market. So if we are seeing flows from US Treasuries into gold, simply because the size of the gold market, it will have a meaningful impact on prices. And if we continue to see central banks replacing these bonds in their reserves, then probably gold prices with an upbeat view is something to have in mind. As far as crypto goes, many speak about Bitcoin specifically as digital gold. What I would say there very quickly is that so far it hasn't shown in a robust way that it diversifies risks as gold does. No, Bitcoin tends to magnify the returns on the upside, but also on the downside, the pain is magnified. So it is becoming part of what people see as a way to diversify, as some believe it is the new safe haven asset to hold. So far, I would say, if your view is a view of markets going up, then definitely a little bit of Bitcoin in the portfolio might make sense. If otherwise you believe markets will be volatile and there is a probability of correction, Bitcoin might not be the asset to hold, at least not in large quantities. That's it for me.
Thank you. Is there one of you that want to add a final touch on this?
I would add something.
Go on.
I would just add, Serge, maybe a counter view kind of on gold. You know, gold is grabbing headlines when the dollar weakens and uncertainty is rising. 2024, no exception to that. I checked yesterday just the extent of gold prices going up in Swiss franc terms, and it's been up over 35% in 2024. So it's pretty clear investors are absolutely flocking to this as a perceived safe haven. But here's the thing, for gold to really climb significantly higher, we'd probably have to see what I would call a seismic shift, like the US dollar losing its status as the world's reserve currency. And we just don't see that scenario unfolding, and urge investors to think about those risks. And let's not forget, gold doesn't generate income. There's no dividends, there's no interest. And historically, its long-term returns have lagged behind equities, and its volatility can be quite high. That's why, you know, we continue to favor diversified portfolios of stocks and bonds, which are built for growth, income, and kind of overall resiliency as your all-weather type solution.
Thanks. Okay, Reto and Michael, just both of you, a few words to conclude our meeting.
Good. So we think gold has its place in a portfolio as a diversifier, right? So we are still optimistic. It's interesting. Also, the gold mining companies are starting to outperform, and everything. So I think that's it up right now. So that there is a lot of demand, and people are looking at the current prices, and that is improved a lot, right? So there is, but we like it in a portfolio context still to have a bit safety here.
Yeah, listen, Madison, I would have loved to make this a 2-2, but I'm sitting with I'm going with the gentleman on this call. Just one thing, I mean, sort of not to repeat what Reto and Esteban said, but this idea that the dollar losing its reserve currency status, I'm with you. That's not going to happen anytime soon. Simply the way things are, it will take a lot of time. But in my view, you know, this conversation is a bit overrated, because what I care is, where is the marginal buyer moving? And, you know, Esteban explained that greatly. Ever since the war in Ukraine started, central banks have bought more than 1,000 tons of gold each year, compared to less than 500 before you know, the world, you know, froze the Russian assets. And so as long as the marginal buyer moves away from accumulating dollars in treasuries, that means in terms of supply and demand dynamics, potentially that's going to be an ongoing headwind.
Okay, so for the sake of time, we extended a little bit the time frame that was dedicated to us. I mean, really a very, very warm thank you to the four of you. I mean, this is always very interesting, and this is the kind of thing that, as you said, Michael, we need one day to meet and to go outside and to spend maybe one day to talk about all of those subjects.
That was
Very
Madison, by the way.
Thanks a lot to both of you. Thanks a lot to your institution, and look forward for the next round of development and discussion around the markets and the economy.